Don't invest a dollar until you watch this. You've worked hard, saved, and are ready to start investing. It's exciting but also scary. One common mistake could wipe out your initial budget before it grows. This error traps many beginners and isn't about picking stocks or market crashes. In the next few minutes, I'll share 5 unbreakable rules to protect your money and build wealth, even if starting small. Ignoring these is like building on sand. Collapse is certain. If you're serious, stay tuned. This could be your most important financial conversation. I understand. Investing seems like an exclusive club, filled with confusing jargon, conflicting advice, and fear of loss. This fear often causes people to do nothing, leaving money in savings, safe but losing value due to inflation. Investing is the best way to build wealth and gain financial freedom. The good news? Avoiding the huge mistakes that wipe people out isn't about being a Wall Street genius or having a crystal ball. It's about discipline. It's about having a system. Most people don't fail because they chose the wrong company. They fail because their entire approach is broken from the start. The single biggest mistake, the one that all the others feed into, is investing without a plan. It's treating the stock market like a casino, tossing money at whatever's trending and just hoping you get lucky. That's not investing. That's gambling with your future. So today we fix that. We're going to build your plan, your fortress, right now. These 5 rules are the blueprint. They will guide every single decision, protect you from fear and greed, and set you on the path to steady, long-term growth. Let's begin. Rule number 1, the rule of the blueprint. Never invest without a plan. First things first. Before you buy a single share of anything, you need to know your why. Investing without a clear goal is like setting sail across the ocean with no map and no destination in mind. You'll just drift, and when a storm hits, you'll end up shipwrecked. So what does this plan, this map, actually look like? It answers 3 brutally honest questions. First, what are you investing for? Is it for retirement in 30 years, a down payment on a house in 5, or a new car next year? Goals determine your strategy. Long-term goals like retirement can handle market swings, but short-term goals require safer options, since you can't afford a big loss when you need the cash. Second, what's your timeline? It relates to your goals. More time means more risk you can handle. The market fluctuates daily but recovers and grows over time. For long-term investments, you can withstand downturns. For short-term needs, protect your capital. Third, what's your actual risk tolerance? Be honest. How would you feel if your $10,000 investment dropped to $7,000 overnight? Panic and sell, locking in loss? Or trust your plan and see it as a buy opportunity? Many beginners think they're daring when the market rises, but panic sell when it falls. This cycle of buying high and selling low is destructive. Your answers to these questions become your blueprint. For example, a young person saving for retirement might have a plan that's heavily weighted in stocks for growth, with some bonds for stability. Stocks are like owning a piece of a company. More risk, but more potential reward. Bonds are basically loans you make in exchange for interest. Less risk, more stability. This plan is your anchor during emotional storms. When headlines scream, "market crash," you don't panic. You consult your plan. When your buddy brags about a coin going to the moon, you don't get FOMO. You look at your plan. This simple paper is your best defense against emotional decisions that wreck portfolios. Rule number 2, the rule of the antidote. Cure yourself of get-rich-quick syndrome. Rule number 2 counters the deadliest investing poison, promising quick riches. We've seen headlines of people turning $1,000 into $1 million on meme stocks. These stories sell fantasies, and chasing them can lead to ruin. Trying to time the market is a fool's game. Here's the hard truth. No one can predict market movements consistently. Attempting to buy the dip or sell at the top often results in missing the best days, hindering long-term growth. Investing is a marathon, not a sprint. Focus on steadily building wealth over time. So, what's the antidote? It's a beautifully simple and powerful strategy called dollar cost averaging, DCA. Dollar cost averaging just means you invest a fixed amount of money on a fixed schedule, like $100 every single month. No matter what the market is doing, this simple discipline gives you two superpowers. First, it rips emotion out of the driver's seat. You're no longer agonizing over whether it's a good or bad time to buy. It's just Tuesday. It's your time to invest. This saves you from your own brain, which wants to be greedy when prices are high and terrified when they're low. Second, it automatically makes you smarter. Think about it. When you invest that same $100 and a share price is low, your money buys more shares. When the price is high, it buys fewer shares. Over time, this averages out your cost and dramatically lowers the risk of dumping all your money in right before a crash. For most of us, DCA just makes sense. We earn our money from regular paychecks, so we should invest it the same way. It's the perfect strategy for anyone starting out because you can begin right now with whatever you can afford instead of waiting forever to save up some big lump sum. This shows how compounding works. Your earnings start earning more. It's slow at first, but grows into an unstoppable wealth snowball over decades. Einstein called it the eighth wonder. The earlier you start, the stronger it gets. Forget quick riches, focus on steady wealth. Rule number 3, the rule of the safety net. Don't put all your eggs in one basket. Okay, you have your plan. You're committed to a long-term, disciplined strategy. Now it's time to build your safety net. This is rule number 3, a principle so old and true it's practically financial law. Diversification. You've heard it a million times. Don't put all your eggs in one basket. It's tempting to invest heavily in a favorite company like Apple or your employer, but this concentration risk puts your entire financial future at stake. Even top companies can face disasters, risking your entire investment. Real diversification involves spreading investments across various types: stocks, bonds, industries, tech, healthcare, finance, company sizes, and countries. The goal is to create a balanced portfolio where some investments excel while others struggle, smoothing returns and reducing risk from a single point of failure. Right now, you're probably thinking, that sounds crazy complicated and expensive. I've only got a little bit of money. How am I supposed to buy hundreds of stocks? This is where being an investor today is amazing. The solution is simple, cheap, and incredibly powerful. Index funds and exchange-traded funds, ETFs. Think of an index fund or an ETF as a pre-made basket of investments. Instead of buying one egg, you're buying the whole basket. For example, buying a single share of an S&P 500 index fund instantly makes you a part owner of 500 of the biggest companies in the US. With one click, you are diversified. These funds are a beginner's best friend. They offer instant diversification, are passively managed with low fees, and remove the difficulty of finding a winning stock. Instead of betting on one stock, you're betting on the whole market. History shows this is the winning strategy, as most professionals fail to beat the market index. That was dense but vital info. If this guide helps you protect and grow your money, please subscribe. I'm here to deliver effective financial strategies, free and engaging the algorithm. Now, let's discuss rule number 4, a silent thief stealing from investors unnoticed. Rule number 4, the rule of the toll booth. Minimize fees at all costs. This rule may sound dull, but ignoring it can be costly. Every investment has a fee, a toll booth to pay. While 1% or 2% seems small, over time it can erode wealth. Fees matter greatly. Here's why. Fees compound against you, just like your earnings compound for you. Let's run a quick, mind-blowing example. Imagine you invest $100,000 that earns 7% a year for 25 years. If your investment has a tiny fee of 0.5%, your final balance is about $429,000. Pretty great. What if that investment had a 1.5% fee? Just 1% more, and your final balance drops to $324,000. That tiny 1% fee costs over $100,000 and nearly a quarter of your nest egg, meaning you might have to work years longer. The financial world is loaded with products that have high, often hidden fees. Actively managed funds charge huge expense ratios to pay for their teams of analysts who, as we just said, rarely beat the market anyway. There are trading fees, account fees, all sorts of charges that just bleed your account dry, drop by drop. So how do you fight back? It's simple. You become obsessed with fees. You make low-cost investing a top priority. Index funds and ETFs are game changers because they track an index and have low fees. Broad market funds often have expense ratios of 0.1% or less, compared to over 1% for many active funds, making the choice clear. Before you put $1 into anything, a fund, a platform, anything, your first question must be, what are the total fees? Read the fine print. Look for the expense ratio. Choose platforms that are upfront about their costs. Minimizing fees is one of the only things you have total control over, and it's a guaranteed way to increase your take-home returns. Don't let these silent portfolio killers steal your future. Rule number 5. The rule of the small start. You don't need a fortune to start a fortune. This final rule aims to dismantle the biggest lie that keeps people on the sidelines, that you need to be wealthy to start investing. We often say, I'll start when I have $5,000, $10,000, or after a promotion. But delay is harmful because your most valuable asset isn't money, it's time. Thanks to some incredible changes in the financial world, the excuse of not having enough money is officially dead. You can start investing today with the spare change in your pocket. Here's how. First, fractional shares. Previously, a stock costing $1,000 per share meant you needed that much to invest, making top companies inaccessible. Now, fractional shares allow investing any amount, like $10, by buying a fraction of a share. This helps build a diversified portfolio even with a small budget. Second, micro-investing apps like Acorns or Stash allow automatic small investments. Their popular Roundup feature links your debit card and rounds purchases up, investing the extra cents. These tiny, consistent investments grow significantly over time through compounding. The point of this rule is to remove every single excuse you have for not starting. It is so much better to start investing $10 a week right now than to wait 5 years to invest $100 a week. You can never get that 5 years of lost time and lost compounding back. This kills the intimidation factor and builds the habit of investing. Once you see your little pot of money start to grow, you'll get excited. You'll be motivated to contribute more. It shifts your entire identity from someone who just consumes to someone who owns. You don't need a fortune to start building one. You just need to start. Here are the 5 rules that underpin smart, long-term investing. They're not secrets or get-rich-quick tips, but proven principles that distinguish disciplined investors from gamblers who ultimately lose. Let's recap them one last time. The rule of the blueprint. Have a written plan. Know your goals, timeline, and what you can handle. The rule of the antidote. Cure yourself of the get-rich-quick disease. Play the long game with strategies like dollar-cost averaging. The rule of the safety net. Diversify. Use low-cost index funds and ETFs to avoid putting all your eggs in one basket. The rule of the toll booth. Be obsessed with minimizing fees. They're a silent killer of your growth. The rule of the small start. Time is your greatest asset. Use fractional shares and micro-investing to start now, no matter how small. The single mistake that wipes people out is investing without this framework, letting hype, fear, and greed make your decisions. By following these rules, you build a fortress around your money. You create a system that protects you from your worst impulses and puts you on a clear path to your financial goals. Investing doesn't have to be some scary, complicated thing. By avoiding these common traps, anyone, and I really mean anyone, can set themselves up for a successful future. The most important thing you can do is start. Now, I want to hear from you. What's the one big question you still have about getting started? Or which of these 5 rules was a light bulb moment for you? Drop it in the comments below. I read every single one, and that's how I know what to cover next to provide real value. And if you haven't already, please subscribe and turn on notifications. We are just getting started on this journey to financial clarity. Thanks for watching, and I'll see you in the next one.